We had a really large number of shareholder increase through COVID, and part of that I think was because we had a lot of younger investors looking for income, and obviously through that period interest rates were very low. So they got the benefit of income and capital growth through that period. So now we're seeing that wound back a little bit because interest rates have actually obviously gone back up a bit, and there's probably cost of living pressures where people have to spend money on other things. But from that perspective, we do think it's an attractive investment for people in their 20s, 30s or 40s because you can really just set and forget it in some way.
The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invest and Anna Christina from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast,
where we take you from beginner to confident investor,
where we can teach you everything you need to know about investing.
So come get rich slow with us.
Hello and welcome back. I'm here with Geoff Driver today, which is very exciting because he's from AFIC, which is a listed investment company. Welcome.
Thank you. Thanks for having me.
We'll get into what it actually is soon, but I wanted to hear your money win or money loss first.
I don't know if it's a money win or a money loss, but I've got a very old car, an Alfa Romeo. It goes back about 20 years, and I've just had it redone. And I've spent a bit of money on that. So that could be a win or it could be a loss. I'm not too sure at this point in time. Time will tell, as always does in investments.
Yeah. We were having a bit of a chat off air about whether Formula One sponsorship is worth it or not. So very fun.
Well, that's way out of our league, I can tell you that now.
What is AFIC?
So AFIC, or Australian Foundation Investment Company, is a listed investment company. So we're just like any other company listed on the ASX, the Australian share market. But rather than, if you look at BHP or Car Group, which runs carsales.com, are both listed companies, we take the capital that people put with us and invest it in a portfolio of shares rather than investing in projects or business projects or those sorts of things. So we take that capital and invest it in the share market, and we try to generate a return for investors over a long-term period. So that's really what a listed investment company is. It's a company structure. It's very transparent. We have to report through the ASX. But I think from our perspective, what we really like about that structure is, in fact, we have a fixed amount of capital. So it means we can pick when we want to actually invest in the market. Mm-hmm. So if you think about ETFs as an example, which are open-ended structures, when the market's running very strongly, they have to obviously buy as the market goes up and the index weightings change, or they have to sell when the market goes down, index weightings change. From our perspective, we don't have to sell when the market's going down, and that really gives us an opportunity. I think gives us a good opportunity to actually invest our money wisely in quality companies for that long-term investment approach. So we actually like the sort of structure that we have to deal with.
Yeah, we talk a lot about ETFs on this podcast. I think a lot of people are familiar with how they work.
You
buy and sell them on the stock market.
They've become very large over the last few years. Absolutely, yeah.
So what are the differences then? You were saying ETFs, they have to just buy depending on the index. Does that mean?
Index ETFs too, of course. Yes, that's right. Yes.
Yeah. Is AFIC more of a actively, if we were comparing it just to ETFs, is it more actively managed then?
Yeah, so it's an actively managed fund. I guess it gets back to the point I was making earlier on, that we can pick and choose when we buy and sell holdings within the portfolio. So it is actively managed. If you think about let's say an index ETF, which covers 200 or 300 stocks within the Australian share market, we only have 60 to 70 holdings within our portfolio. So we can actually select the companies we want to own that we think can deliver those sort of long-term returns over that sort of long period. I think the other thing that people tend to forget about listed investment companies is because of the company structure, they actually can build up reserves over time. So from that perspective, when let's say through COVID where the market cut its dividends by 25%, if you're an investor in an index ETF, your income went down 25% through that period. Well, for a company structure, we've got reserves, so we actually continued our dividend through that period. So in a sense, if you're looking for that consistency of income or income to reinvest back into the market or into the fund, the listed investment company offers that I think that advantage.
Okay, so more consistent income.
Definitely, yes.
What are the other differences too? If we're just going to dot point them out, it's a different structure.
Yeah, it's a different investment approach, I think. Also, the after-tax returns you get with an ETF, so it's a trust structure, as you well know. So basically any tax that's paid through the ETF goes straight back to the investor. So the end investor has to deal with that. And sometimes they don't know what that is until they get their return at the end of the year to do their tax return. With a listed investment company like AFIC, basically it's just fully franked dividends. So in a sense, that that you're going to get fully franked dividends.
They're all fully franked.
That's right, all fully franked. So you can actually manage how your tax is paid, or your tax position is through understanding what the dividends are going to be.
Can you explain fully franked quickly for anyone who's not?
Yeah, basically the franking system is it's a credit for the tax paid by a company. So let's assume you're on a 30% tax rate. When you dividends pass back through to the end investor, they don't pay any additional tax because the tax rate at 30% is the same as a franking rate. So it's basically a neutral. Clearly, if you've got a lower tax rate, you get some refund, and a higher tax rate, you actually get to offset some of that tax to that higher rate. So that's really the franking system, and it's been in place for a long time. And a lot of particularly retirees, I don't know, it's not your sort of client base, but they obviously very much appreciate the fully franked dividends. And I think it's a very unique system. Australia is one of the few countries that has it.
Yeah, I like it, even just having to pay less tax. Like if you're only paying 7% instead of 37%, that's right. Quite nice.
That's exactly right.
Yeah.
Exactly right. So as I said, from that perspective, we think the LIC structure, the company structure, offers a really great advantage to investors. That's just something that people don't focus on so much, but you really need to understand what the after-tax return benefits are.
Yeah, our tax system seems quite complex on the outside if you don't know about it. So it's hard to really picture what the overall returns might be if you're paying the full tax rate on some, or a lot of ETFs have maybe partly franked dividends, which is confusing as well.
And there's also realised capital gains within that as well as they rebalance the index. So you don't get that with an LIC. So without going into too much detail or too much complexity, but if we sell a stock within the portfolio, we pay tax on that, but that tax is then we get franking credits for that. So that's part of the franking credits we can pass back to investors. So the end investor doesn't have to worry about any of that within their returns, which we think is a really strong point for an LIC such as ourselves.
So why would someone actually pick an LIC over an ETF? It sounds like they're great for retirees if you want to pay a little bit less tax on your dividends.
Yeah, look, that's obviously one part of the market. We were talking earlier on before we started the podcast about the fact we had a really large number of shareholder increase through COVID. And part of that, I think, was because we had a lot of younger investors looking for income. And obviously through that period, interest rates were very low. So they got the benefit of income and capital growth through that period. So now we're seeing that wound back a little bit because interest rates have actually obviously gone back up a bit, and there's probably cost of living pressures where people have to spend money on other things. But from that perspective, we do think it's an attractive investment for people in their 20s, 30s or 40s because you can really just set and forget it in some way. And the other point about it is we're very low cost. So we don't run a external funds management business, so there's no external fee going out to an external fund manager.
And that usually happens with ETFs?
Not with ETFs, but with other fund managers. So I guess the point is there that you're not paying 1%, you're not paying any performance fees. But having said all that, our management expense ratio, the cost to investors is 0.15, so very competitive with an ETF as well.
Yeah, so, especially for an actively managed
that's exactly
ETF.
Right.
Crazy.
Exactly right.
There's some passive ones that I've seen for 0.6 still.
Yeah, that's right. So there's ETFs and there's ETFs, as you probably know more than I do, but you've got to be very careful about. Like all these things, it's a matter of looking at or investigating what the cost is, because cost is the thing you're going to get with investments. You got to have a cost up front, and then it's understanding the relative return based on those costs as well.
How does someone actually invest in AFIC? Is it like an ETF where you just log onto your broker and you pay your brokerage fee?
Yeah, exactly the same. It's listed on the Australian Stock Exchange. Its code is afi.com.au. Oh, sorry, that's the website, it's got but the code is AFI.
Yeah. Why do you think LICs just aren't as popular kind of on the online world as ETFs? I feel like ETFs get a lot of media time, but not LICs.
Yeah, so I think, there's clearly been a massive explosion in that industry. I think they would spend a lot more money on marketing and advertising than we could possibly do, because we like to keep our costs relatively low, clearly, as they do. But they have grown substantially because I think of that. The other thing is, look, to be quite honest, our performance can ebb and flow, whereas an ETF clearly just follows the market. But we find, particularly through more volatile periods, investors flow back to the LICs because of that sort of more not conservative, but the actively managed portfolio.
More like maybe consistent, maybe not consistent, but yeah, a little bit more stable.
Yeah, that's right. And you've got the dividend to flow to go with it as well. So, yeah.
Definitely. AFIC has been around for nearly a century, which is crazy. Like, a lot has changed, I'm assuming. What's been the secret to that kind of longevity and trust, and why should we care about that track record today?
Well, I guess the fact it's been around for so long probably goes back to the sustainability of the investment approach and the model. So I think that's really important. As I said earlier on, that model has been really about that sort of long-term investment approach, and over that period we have delivered good returns. I suppose the other thing about it, though, is you should always look at more recent track record, because it's clearly important to investors at the end of the day what they're getting over the last 5 or 10 years rather than what they've got over 100 years. Clearly, that's not where investors will be looking. I think from that perspective, the fact that the model has lasted that long suggests that a closed-end fund with a fixed amount of capital can be a good vehicle for people to find good returns in terms of the way we go about our investment approach. And I think that's the real lesson from the sort of long history of it. There have been a lot of LICs come to the market more recently, and they've sort of been a little bit different in a sense. They've come from sort of the funds management background, which I talked about earlier on. So the fees are a lot higher. There's nothing wrong with fees as long as you're getting the investment returns. But if you're not getting those investment returns, then that can be problematic. And that's really what's happened a little bit over the sector, getting back to what you were talking about earlier on, why people go on to ETFs rather than LICs. A few of the LICs haven't performed that well, and I think it's muddied the water for the whole market, unfortunately. But if you go back to how long we've been in place and how long our other LICs have been in place, which have been 20, 30 years, we have a strong track record of delivering those returns.
I'm trying to imagine what it would be like 100 years ago, buying and selling shares.
Well, I'll tell you, there's one stock that's in there, that's Coles. That was there 100 years ago.
Really?
So, yeah,
I didn't know that was Coles.
Yeah,
wow.
That's right. I think BHP was probably in there as well. But, 100 years ago, very different.
No, what did you do? Did you go into a shop or something with your bit of paper? How did you actually buy shares back then? I know you went around back then.
Yeah, well, I wasn't around there either. Thank you very much. You go to your broker. You basically you walk into your broker's office, and he'd say, okay, I'm going to buy something on the exchange, and you get a paper saying, he'd go in and buy through the trading desk, through the trading floor, I should say, not the desk, and basically get a bit of paper saying, here's your certificate, this is how many shares you own.
Crazy.
It's very different these days, thank
I'm
goodness.
glad things are online. I don't need to worry about where my bit of paper is.
Yeah, that's right. All you have to worry about now is other things online.
Yes. new threats.
That's right.
Going back to people in their 20s or 30s, our audience is generally, we have a lot of beginners, but also people who are kind of, I don't know, maybe mid-late way along their journey. They might have a bit of property. They might have some ETFs. For those people who are just getting started, what role could an LIC like AFIC play in their portfolio? So
it gets back to the sort of principles I was talking about earlier on. So it's obviously exposure to Australian equities. And it's
just Australian?
Yes. We have some New Zealand stocks in there as well. So it's that, again, a little bit different than the index. And we don't have too many, but clearly there's some good companies in New Zealand that we like to invest in. So we do that.
What New Zealand ones are in there?
Main Freight, which is logistics firm, Auckland Airport, which is one of the last infrastructure assets available to buy on the exchange. So there are a couple. Port of Tauranga is another one, which is a major port in New Zealand. So there are some good companies. There's smaller ones there as well that are quite good to look at as well. So we've got Australia, New Zealand core, I guess, exposure for Australian equities part of the market. I mean, there are clearly a lot of index ETFs which cover Australian market as well. It really gets back to the principle of what you're looking for in terms of, that sort of sustainability around income a little bit more. So you get And income, you don't necessarily have to have it paid out. You can reinvest clearly because we're our company structure. You can do it through a dividend reinvestment plan and those sorts of things at no cost. So there's that benefit as well. I know ETFs have that as well, but it's a fully franked nature of that I think is important. And look, over the longer term, we will look to outperform the market. That's the other part about it as well. So not in a huge way, but we would like to think we can deliver performance in a small way over the index over that period of time. And getting back to what I was saying earlier on, if you look at your you need to look at your after-tax returns. So in a sense, as an investor, and we think our after-tax returns over that longer term will be better than an ETF, I should say.
Have you outperformed the market?
Over the very long term we have. So more recently we're slightly underperformed. And so we don't try and keep up with 1 year performance. We're really after 5 and 10 year performance. That's the other part about it. If you're trying to chase just 1 year all the time, then you'll end up probably doing worse than you.
No, there's been like a different industry every year. I feel like it was like lithium stocks and then it was like crypto things. And now recently it's been gold. Has been doing
That's
well.
the other thing. So that's one of the reasons we're underperformed recently, gold. So
you don't have any gold?
No, I don't have gold. It's too
No African gold mining companies?
No, a bit too speculative for us.
Yeah.
And then look, at the end of the day, if people want to invest in gold, they can do it through a gold ETF, for example. So they can do it themselves, get back to the portfolio structure that you want to decide for yourself. That's how you do it. So they're the sort of things I'd think about in terms of portfolio construction. It's very much an Australian equity and New Zealand exposure.
Could it be a replacement for something like VAS or A200?
Yes, clearly it could be.
Yeah,
Yes.
so you buy like
anything that's focusing purely on the Australian market, I think so. Yeah, absolutely.
Yeah, okay. So maybe you do like AFIC and then something like VGS, not specific advice, but in terms of trying to get like the international exposure, a bit of Australia as well.
Yeah, that's right. I mean, I think, look, as I said, ETFs have been great for investors because in a sense they've given access to a whole range of different asset classes and allowed them to sort of decide how they want to structure their portfolios. But I think the LIC sector has been left a little bit behind because of that, because of the significant growth in ETFs. The other thing about the structure, which I should have mentioned earlier on, is that sometimes the share price can trade at a lower value than the actual value per share of the portfolio. So at the moment, the share price is trading at about a 10% discount, which is very unusual for AFIC. Over that 30-year period, we've probably traded at close to a slight premium.
Why has that happened?
Because the market's just been basically going one way. So if you've been in an ETF, a market, I mean, we've had obviously recent volatility with Liberation Day and all those sorts of announcements. But if you look at over the last few years, the market's basically just been sort of going up. And in that sort of context, when the market's less volatile, the LICs, particularly like ourselves, get left behind. When there's a little bit more volatility, or as I said earlier on, when there's a pressure on dividend income, LICs, or particularly ours, people tend to sort of float back into them. So we've, a few years ago through COVID, when I talked about earlier on about the sustainability of income and what we were paying, our share price was a 20% premium. It's clear that's too much the other way. You shouldn't be paying 20% premium for a listed investment company. But there are periods where we will ebb and flow. And if you think about it, at a 10% discount, you're buying a good quality portfolio at 10% than what you would pay through an ETF at the moment. Yeah.
Goes into more of those. We've done a few episodes on value investing with some people who love that kind of investing. So that's amazing.
Yeah, look, and there's nothing wrong with buying at a 10% discount and selling at a 5% premium if it gets there. That's a way to make money as well, but that's what makes a market. So I think it's important that people understand potentially those opportunities as well. So one of the other, I guess, features we have within AFIC and the other LICs we run, unlike a dividend reinvestment plan, we run what we call a dividend substitution plan, and I'll put that jargon substitution plan for one side in terms of that jargon for one side, but what it basically says is that if you take the dividend, it's not treated as income for tax that year. So that means you don't get the franking credits. So it depends on where your tax rate and how you can use franking credits, clearly if you want to use it. But what it basically does for an investor is defers your tax outcome to you actually sell the shares. So you still get the same shares at a DRP price. They're not treated as income, but they're treated as part of your overall capital base or tax base for the share. So you only have the taxing event on that when you actually sell the shares 10 years down the track or something like that.
That's pretty cool.
Yeah. So again, I can't give tax advice, but it really is. It's on our website. Have a look at it. And if you think, you obviously should consult your own tax advisor or whoever you might think about asking about those sorts of things. But it's a really unique thing that only a few listed investment companies have in Australia, and it's well worth looking at.
Because people are always asking me for tax hacks, and maybe this isn't hack, but
tax
we'll use that word. That's pretty cool. So if you're going to retire in 10, 20 years or whatever, you don't pay tax now on your higher income. You wait till you retire, not earning money, and then you pay tax then. That's pretty cool.
So that's right. So if you're in a low, that's right.
I feel like we should call it like, I don't know, dividend deferral or something rather than substitution.
Yeah, well, I'm not too sure. Look, go on the website, have a look. It's well worth having a think about. As I said, particularally considering you are in tax position.
You've intrigued me now.
Yes, okay. We'll have a look.
It's not spoken about enough. Yeah.
Yeah. It's very different to what you get with an ETF, for example, where you obviously have to pay the income tax, and it's not for everyone. But people should at least have a look at it.
But if you can defer your tax.
Yeah.
I guess it's good when you're a bit younger.
You still have to pay tax when you sell something.
Yes.
It just depends on your tax position at that point.
Yeah, I guess for younger people, like I'm 27 now, it feels like a long, long way away.
Yeah, that's right. So a lot of people do it for their children, for example, because they get taxed at the highest marginal tax rate at this point in time.
Yes, that's such a good use as well.
That's right.
Or if you're thinking about going on like parental leave as well, that could be a time you...
Yeah, I don't know exactly all the tax outcomes, but it's something to think about anyway. So yeah.
Amazing.
As I said, I can't give tax advice, but something to have a think about.
We found a maybe tax hack.
We don't like. I
said that.
Yeah, you said a hack. I'm not going down that route.
No. One of the first books I read on finance was The Barefoot Investor.
Yes.
Why did he list AFIC as like his recommendation for investing?
He liked the low cost. Mm-hmm. He liked the performance. He liked the transparency in terms of being listed on the ASX. I mean, the other thing we do, we have shareholder meetings and other briefings for investors every 6 months. So in a sense, the investor, if you want to, can actually go and meet the fund manager.
Yeah, you have one coming up, don't you?
Yeah, we have an evening one coming up on the 28th of May, an evening one, which we try and do that to cater for sort of younger audiences who want to come along and see that. And anyone can come, or is it any investor? Yeah, no, anyone. Just got to register on the website. Okay. So and we actually run 3 other funds. Mm-hmm. And one of the other funds is Mirrabooka, which is a small mid-cap fund. So there's a lot more stocks in. So an AFIC portfolio, you probably know most of the major holdings in there. But in Mirrabooka, there's a lot of holdings which you probably wouldn't know so much about. Mm-hmm. And it really just shows the breadth of the investment team, but also the amount of companies we're actually covering within the portfolios. So I guess getting back to the point I was trying to make earlier on, there is transparency in what we do. So he liked that. And I said the low cost, he certainly definitely liked that. And he liked the consistency of income and the fact you can reinvest back into the fund through dividend reinvestment plans. The other thing I think he did like, there's no conflicts with us. So in a sense, we're not trying to run a funds management business to make money. We get paid a salary, that's fine, but we're actually not running this business to make excess profits off our shareholders. It's like a mutual fund in some ways, yeah. Okay, yeah. Yeah, so as the fund gets bigger, the relative costs go down to the shareholder. So, as I said earlier on, our management expense ratio is 0.15. Some ETFs are around that or a bit lower. I know some are a bit lower and some are a bit higher. But as that fund gets bigger and bigger, and AFIC's about a 10 billion portfolio now, as it gets bigger and bigger, the actual relative cost should come down because we're actually not getting any income from having a bigger portfolio. Amazing. Yeah. How do you actually pick companies that AFIC invests in? Yeah, so as I said earlier on, we've sort of got about 60 or 70 holdings within the portfolio typically. It can vary between that sort of amount. It's probably a bit lower at the moment. We focus on what we call quality companies. So basically those companies who have a sustainable leadership position in industries or building them over time. We like ones that have got good quality balance sheets because where you can lose your money is when a company is highly geared and all of a sudden it gets itself into trouble. And that's where that can be a real problem. When you say highly geared, do you mean they've borrowed lots of money? Lots of money. So they have a lot of debt on their balance sheet at the end of the day. And we've seen over the past that's not been a good place to be, particularly as either the economy's had a downturn or interest rates have started to go up dramatically. So that's not a good place to be as well. We like companies which have got good quality management and boards, and particularly those companies that have got a bit of skin in the game, particularly some of the smaller companies where the managers actually, or the shareholders actually have quite a large ownership, and they have actually been probably the founders of those particular companies, or larger companies act like that, so they act in the best interests of shareholders. We like companies that have got high return on capital. So what we do find is that share price typically follows increased earnings. So if you've got a company that's reinvesting appropriately and generating good returns within its business, you'll find over time its share price should increase over that sort of longer term. We also are very circumspect about investing in companies who have large exposure to external influences like government policy and those sorts of things, because they can change quite dramatically.
Yeah, give us an example of one of those.
So, if you look at some of the hospitals, for example, Ramsay Healthcare, for example, that's obviously in the health sector. What they get is dictated by what the insurance companies can pay, and the insurance companies obviously are dictated to by the government about how much they can increase their costs or their fees back to their customers. So
yes, which is good for healthcare, because we don't want to be like America, but not as much for an investment.
Well, I think you find that there's always a balance. You've got to have like anything, I guess, at the end of the day, you've got to have an ability for hospitals to generate a return to actually invest in more hospital staff and everything else, and pay the wages and what have you. But on the other side, clearly you don't want to be in a position where healthcare is such as most people can't afford it, as it is in the US, unfortunately. Yeah.
Was there any other factors that you consider?
They'd be the main ones. I think. They'd be the main ones, I think, at the end of the day.
What's an example of like a good company, not so people can run out and buy it, but just so we can see like all of those factors in play? Is it something like Coles? Well,
Coles is a bit more. Let's pick Goodman Group, which is an industrial company which actually has exposure to industrial sites, but it basically has them all around the world, and those sites can be used for data centers or distribution centers for Amazon, for example. So it's run by someone who's Greg Goodman, who's got a large holding within the company. So it gets back to that sort of owner-driver type, what we call them, in terms of their exposure or their drive to make that company better and grow its profits. But also it's got conservative gearing. It's got a leadership position in this industry, and not just in Australia but globally. So that's the sort of company that would be as high on our list, and it's in the top 10, I think, of AFIC's portfolio at this point in time.
And the point around it not being too influenced by governments, if it's around the world, if one government regulates it, it doesn't matter as much.
Look, it's, as I said, data centres have sort of been on the needed, and obviously Amazon distribution centres are needed. So it's quite a unique business, and it's has the ability to reinvest back into its business at quite an attractive rate as well.
Yeah. Awesome.
Yeah.
What are some of the most common myths or misconceptions you hear about LICs, and what do people get wrong when comparing them to ETFs?
The first one, which I've mentioned earlier on, the LICs always trade at discounts. That's not right. So in a sense, I mentioned earlier on.
People think they always trade at discounts.
Yeah, that's right. I think a lot of people think you buy an LIC, it's always going to trade at a discount. 30 years of our history shows that's not necessarily the case, and there'll be a lot of other LICs where that's not the case either. So that would be one of the misconceptions. I think one of the other ones, for some reason, people think LICs are complex. Well, actually, hopefully, I'll explain a little bit, but they're actually not complex. They're listed on the ASX, their company structures, they have to do company accounts every 6 months. They're regulated by the ASX and corporate governance rules. So they're actually not complex. If I look at an ETF, in some ways that can be a little bit more complex. because it's opaque in the sense of the way the index has changed and what their weightings are within the portfolio. As I said earlier on, you don't know exactly what distributions you're getting until the end of the year, whereas AFIC, you can plan around those distributions relatively easily because it's just fully franked dividends. So they'd be a couple of the misconceptions about LICs. And I suppose getting back to what we were talking about earlier on with the barefoot investor, LICs are not just for old people.
Yes.
They're actually part of an investment menu that many people should actually have a look at. And they won't always be right for people at the end of the day, but there's always an opportunity in investment markets to at least consider them at an appropriate time. And I think that's really an important message for listed investment companies.
Yeah, I think with anything finance related, it seems complex and confusing until you start to dive into the jargon yourself. Like with fully franked dividends, you could be like, oh my God, I don't know what that is. That's very confusing. But then you learn about it and it makes sense. So I think it's just another one of those like little hurdles to get over and then you understand
Yeah, look, that's right. And we're guilty in the investment industry. We're more guilty than many that we actually do tend to talk in jargon sometimes and expecting people to understand it. And then we walk away and think, well, how come they didn't understand what I was saying? Because I understood what I was saying.
I said all my acronyms,
That's right. Yeah. So that's right. I mean, that's why I think, getting back to LICs, if you look at them, are very, very simple structures with very simple outcomes.
So they try and make you money. They try and pay you income.
Yeah, that's
similar
right.
to ETFs, but slightly different structure-wise.
That's right. Yeah, and hopefully the tax outcome for that's slightly different than an ETF would be.
If someone is listening and they want to learn more about AFIC or they actually want to go and invest in an LIC, where should they start? So
obviously our website, afi.com.au, which I mentioned earlier on, and also there's a lot of information on our website. There's also a listed investment company association called Listed. So that covers all of the listed investment companies, and it's called listedassociation.com.au, I think is the website. And that's just been relaunched. So that covers information across all the LIC industry. It's got brochures on there about how they work, what to look for. So I think that's also a good resource at the end of the day. We do a couple of brochures on our website. So we have a lot of investors who invest on behalf of their children or grandchildren, funnily enough. And when I say children, it could be children in their 20s rather than,
That would
so
be nice.
we have a couple of brochures on the website which talk about how you go about that and how you might think about doing that. So that's actually worth looking at as well. And if you're running a self-managed super fund, we have a bit of information about that as well within the website as well. So
awesome. So the Listed Association website, it's got very nice branding.
I know. So it's just redone it. Yes.
Yes. Have a look at the AFIC website and then just find a broker that you can buy it on. So it's the same as buying an ETF. Go and type
online broker. Yeah, can do. I mean, it's very simple. A few of the brokers have research. This you can try and find as well, but that's well worth looking at, yeah. Absolutely.
Yeah, definitely. You mentioned your shareholder information evening. Did you say it was the 28th of May?
That's right, yes.
Where is it, in Melbourne or Sydney?
It's in Melbourne at the Sofitel on the 28th.
Very nice.
Yeah. We'll offer some refreshments beforehand.
Is it free?
Yes, absolutely.
Oh.
So just register on the website. Absolutely, it's free, and people are more than welcome to come along. And we'll be covering all four of the companies which we run. So as I said earlier on, there's Australian Foundation, which is sort of large companies, I should say, but we've also got other companies like Geoff, which uses option strategies to generate some income. I won't go into options because that all goes right down the jargon route. Mirrabooka, which is a small mid-cap fund, so anything outside the top 50. So a lot of interesting companies within that portfolio.
Awesome. Definitely, I think everyone should attend the shareholder meeting if you're free, or the information evening, because it's a money win with free drinks, and also just great, even if you're not going to invest in AFIC, to learn about stuff.
A whole range of different companies, exactly right.
Yeah.
So, and you'll hear about large companies and you'll hear about smaller companies within each of the portfolios.
Awesome. I'm sad I can't come. I'll be in Vietnam, unfortunately.
Well, it's probably good for you, though.
Yeah, it'll be fun, but this sounds good as well.
Yeah, okay. Good.
Thank you so much for joining us. This has
Thank
been
you.
lots of fun.
Thanks, nice. Good. Thank you.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invests, or me at Ana Cristina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.